Sounds perfect. So we kind of covered the easier part of this so far. It's just kind of thinking of what is a trade or business. So we have to have that underlying groundwork. We have to have those fundamental basics down because before we can move on and then start building on it, we have to make sure that we at least have what a trade or business is covered. And performing services as an employee is not a trade or business. We have an idea what the traditional trade or business rules are. But then we get into this zone, rental real estate activity. This really generated so many questions when they came out with the law and the proposed regs and the final regs. What they did is they did actually, I think, a pretty decent job of trying to answer that. So if we go back to that section 162 and they say that's the standard, and we're going to use that to determine if an activity is a trade or business for purposes of this deduction, the section 199A deduction, well, right away, that can prove problematic for real estate activities because Section 162 kind of, for the most part, for real estate activities, doesn't really seem to apply for the most of those activities. What they did, and they did this at the same time as the final regs, they came out with a notice, 2019-07, that is a proposed regulation, but they released them at the same time, concurrently, along with the final regs. So yes, it's proposed, but it gives us guidance under something that is a proposed safe harbor. So this safe harbor rule says that we can treat rental real estate as a trade or business solely for these purposes, so that we're talking about just for qualifying for the purposes of the Section 199A, if we follow these safe harbor rules. In fact, under this, it creates a whole brand new term for us called rental real estate enterprise and introduces us to a 250-hour of service rule. So before you get too worried, we are going to go in depth into what this notice says and what the requirements are, but this is kind of an interesting take on it because they said, okay, yeah, for most other normal intents and purposes, your rental real estate isn't a business, but for this deduction, tell you what, we're going to create a safe harbor rule that tells you whether or not that you can qualify under those safe harbor definitions. So what do they guide us? How do they say you can determine that this is truly a business for the purposes of this deduction? First, they said you got to keep separate books and records. And it's kind of curious, and I don't know why there was this change, but I told you that there was final regulations January 18th, and then they issued corrected final regulations on February 4th, a couple weeks later. They changed this word to say separable instead of separate. So I don't really know exactly what that means. I don't know if that means like if you keep it in QuickBooks that you can run a separate report, all the data is merged together, but you can run a separate report that says, hey, this rental is, this income and expense, assets, whatever. I don't know exactly what to take on that, so I wanted to put it out there because it was curious. They changed the wording, but you can kind of see what their intent is to say, okay, if you're separating the books and records and keeping separate bank accounts, they are, indicating a separate bank account there. You can't have it merged with personal. If they're saying this really is operating like a business as a rental real estate enterprise, well, you should have a separate bank account foremost and separable books and records as well. They want you to maintain contemporaneous records and show 250 hours or more of rental services per year per enterprise. And we're going to keep defining those a little bit more so that you can really know what the extent of these items are. As we look at what are rental services, we want to meet a 250-hour test, but what are rental services for the purposes of this proposed revenue procedure? They did give us guidance there. They said, okay, if you're advertising to rent or lease the real estate, that is a qualifying rental services for the purposes of the safe harbor rule. If you're negotiating and executing leases, that is as well. If you're verifying information contained in prospective tenant applications or collecting rent, so true, rental real estate activities here is what they're going for. You're doing the daily operation or maintenance or repair of the property, managing the real estate, or purchasing materials for it. But this last one, that one is really curious to me. Supervising employees and independent contractors. So in my mind, I'm envisioning you're sitting back with the iced tea in the lawn chair and you're supervising the independent contractors that are maintaining the property. Well, supervision, according to this, does qualify. So it is knowing, hey, these are all the activities they say do qualify as rental services for the purposes of the safe harbor rule. They did, however, also specifically exclude other activities, all generically under this financial or investment management activities. So they said, okay, well, you can do all those other things and count those towards your hours, but we're not going to let you count when you're arranging financing. When you're procuring that property, you're actually trying to purchase or make an investment on that property. You're studying or reviewing financial statements or reports on operations. Just because you're studying the operation and looking at those financial statements, that you're really not operating the rental and how they're looking at it. Or if you're planning or managing or even constructing a long-term capital improvement, well, that's really not part of the real estate activity. They also specifically excluded the hours spent traveling to and from the real estate. So I don't know about you, I have some clients that actually have to drive pretty far because their real estate property is outside of their home city. Those hours they spend traveling don't count towards the hours of operating it when they're trying to meet that safe harbor test. So know that there are specifically things that are excluded at the same time as they give you guidance saying, here's all the types of activities that you can count. Additionally, they say, okay, let's give a little more guidance as to who can actually perform these services. So the logical one, the owner of the real estate enterprise, employees, you can count time your employees are working towards your time, agents, or even independent contractors. So this is a little different way of going about it. It's not just what that owner itself is doing. You can count the time that independent contractors are putting into it. So maybe they're the ones that are doing some repairs or doing all those functions. Maybe you have a management company that's collecting the rent and double checking those applications. They're an independent contractor of yours. You can count their time towards this test. So it is rather interesting how they went about defining this. We also have to look at there are some excluded property from the safe harbor rules. This is not all real estate. So they say if you have any property that you've used as a residence for any part of the year, under Section 280A, we kind of generically refer to this sometimes as our 14-day rule. Well, if you have property that falls in that, okay, it's going to be excluded from the safe harbor of being able to call a real estate enterprise. They also specifically excluded, I remember I told you before when we were kind of looking at danger zones when we try to say, is it a specific trade or business? Triple net leases. Definitely a tough area because a triple net lease, the way that they have specifically defined this, it includes a lease agreement that requires the tenant or the lessee. They have to pay taxes, fees, insurance, be responsible for the maintenance activity for the property in addition to rent and utilities. It kind of almost sounds like it takes the owner out of the picture because now the tenant is responsible for everything. So they did exclude specifically from these safe harbor rules the triple net leases and that 14-day rule properties if you're using it as a personal residence. So if everything else is included and we know that those are the ones that are specifically excluded, then we start having an idea form or make sense and start to take shape for these. As we look more into the safe harbor rules, they said something about they expect contemporaneous records. Well, okay, what are they looking for there? What exactly are they hoping for contemporaneous records? And that one they defined it saying, okay, we want your time reports and your logs and any other similar documents regarding the following items. Well, if we're trying to meet a 250-hour test, we've got to have the hours of all the services performed. And not only the hours, just having a log of hours doesn't help. They want a description of the services performed, what dates they were performed, and who performed them. So it's okay if it is a contractor or an employee or somebody, but you should have it logged. Hours, description, date, and who performed the services. So contemporaneous, meaning that you're doing it as you go. You can't just do these all last-ditch effort all at the end of the year. You're supposed to do these records as you go. So that if we keep a log, or if the person that's wanting to take this as a rental real estate enterprise keeps a log, this is what the log would look like and have on it. And again, even in this section, it's that they once again reiterated separable, and that was another point where they changed that in the corrected regs is separable instead of separate. books and records, and a separate bank account. So they've said that a couple times. It's pretty easy to get the feeling they are wanting separate or separable books and records and bank account, so that it's hard to say that it is performing in that fashion if they're all mixed and jumbled together. Now, as we look at that rental real estate enterprise term, this is curious too, as they said, an interest in real property held for the production of rents and may consist of an interest in multiple properties. This is where we can actually aggregate, and I probably shouldn't use the word aggregate because that means something else in there. We can combine together multiple properties, but we have one of two choices. We can either treat each rental property separately, or we can treat all similar properties as a single enterprise. So let's say that you had 10 properties, 5 are commercial and 5 are residential. Since commercial and residential cannot be part of the same enterprise, you can say, well, here's my one commercial real estate enterprise, and that's 5 of the commercial ones, and here's my one residential real estate enterprise, and that's 5 of my residential ones. What that means is you can then count all the hours on the 5 commercial and have the records for the 5 commercial and the separate bank accounts and records and everything and so forth on the 5 commercial and then also on the 5 residential. So you may say, well, why would you want to possibly separate them out that way? What if all your commercial properties were all very profitable and your residential rental ones weren't? I mean, there's different ways to look at it, because we would want the deduction and want to call it a rental real estate enterprise if it's profitable, so we can qualify for this deduction, and maybe not if they were at losses. And same thing if you were to treat them all separately. Just, it's one of two choices, all separate or all together. Mindful of commercial and residential are two separate types of enterprise. The other thing they say is you can't change that treatment for year to year without some major change in facts and circumstances. So you can't say, well, this year I'm going to group them all together, my commercial and residential, it's one enterprise, but next year I'm going to separate them all apart. No, it is that you have to maintain, again, consistency is the recurring theme over and over and over here. Consistency, consistency. And they did specifically, once again in this section, talk about 1099, saying, okay, if you are going to treat this as a rental real estate enterprise, like a business, well, you should be doing the 1099s as well. So that, I think, is one of the areas they're going to be able to catch people if they are not doing those 1099s. So as we continue a little bit more, they say, and furthermore, we're going to let you treat, and so this gets a little bit more into something we call self-rentals. We'll let you treat that rental activity as a qualifying Section 162 trade or business and, take this deduction if that rental activity is related to a commonly controlled trade or business. Same owners must own 50% or more of both property in the business. One of my examples, I have an automotive company that also owns their land and equipment that they're renting from. Well, the owners own 100% of the automotive company, own 100% of the rental company. Well, this would be considered because, they both are commonly controlled. The one is a Section 162 trade or business. The rental can fall in that category, and it's important that it is not a specified service trade or business. We are going to get into those definitions in a moment, but specified service trade or business, why would that matter? Because by default, if it is a specified service trade or business and you have that related renting company, it's all automatically treated as a specified service trade or business. So that's one of the areas that it kind of exempts us out of saying, well, wait, I've met these rules and, that I'm under the safe harbor rule. But the problem is if there's a related or commonly controlled business interest that's renting from it, that if that business entity is a specified service trade or business, then all of it is treated as a specified service trade or business. So a couple little things to watch out for is that common controlled. In one way, it can help because maybe the rental of that equipment or property just gets treated as a business for the purposes of being able to take the deduction, or that it can maybe call it a specified service trade or business by being related as well. So a couple things to look for as you look at self-rentals. There is a lot more to self-rentals, and some of that we cover in the final regs section, but just kind of watch to see if there's that common control aspect of it. So if you've gone through and you're kind of like, what, I think this is really a great thing. I want to take the safe harbor election. Well, how do we do it? We have to attach a statement to the return or a K1, because if it's flowing through from a business entity that reports on a K1, that Revenue Procedure Section 3.03 is satisfied, and we have to say, under penalties of perjury, I, or we, depending how you're signing it, I put both there for you, declare that I've examined the statement and to the best of my knowledge and belief, it contains all relevant facts related to the revenue procedure and they're true, correct, and complete. So basically, you have to do this under penalties of perjury statement, and it has to be signed by a taxpayer or representative who has knowledge related to the statement. So they're asking to say, okay, they know about what the safe harbor rules are, they've met all that, they're willing to sign off on it. That's what the election consists of. And if you make that election, then it's treated as, for purposes of this deduction, the QBI or qualified business income deduction, myriad of names, you get to take that as a deduction on that individual's personal return. Now, what happens if they really don't satisfy that safe harbor rule? It does specifically say that rental real estate enterprises could still be treated as a trade or business for the purposes of this code section if the enterprise otherwise meets the definition of trade or business, which, remember before, they kind of generically said it's based on facts and circumstances. And here's the thing that's a little worrisome. We have to be careful because the whole reason they created this revenue procedure and the safe harbor rules is its whole purpose is defining qualifying rentals for this purpose. So yes, you could still qualify outside of that, but I think you would have a bit of a battle ahead of you if you're not meeting these tests. So yes, it is true, and they say that it is true if you meet it otherwise, but I would just kind of tread lightly if you weren't wanting to qualify under the safe harbor rules. So that is a lot about rental activity and the safe harbor rules, and these, remember, are proposed regulations. So it may not even be that all of the aspects of this retain that nature 100%, but it's letting you know, hey, this is out there, they've tried to define it, that we can go ahead and move forward with it. It is that maybe it's going to be tweaked a little bit in the future as they come out with maybe some final regulations or guidance on even these safe harbor rules.